So the debt problem, I would say very low chance. I keep saying nothing stops this train, which is a reference to the fact that almost anything they do is unlikely to address the fiscal deficit. Um, and this, I mean, this goes back more than a decade. I mean, this is a culmination of multi-decade ago entitlement decisions that were not tuned toward demographic changes and not changed amid demographic changes. The entire war on terror, or the bulk of it, that was rather unproductive and yet expensive. There are various estimates for how much that added to the debt. Is going to continue to add to the debt through interest expense. There was a global financial crisis where we went through a gigantic private debt bubble, and a lot of that debt was kind of indirectly pushed up to the sovereign level. And we ended 40 years of structurally declining interest rates. So we had 40 years of rising debt to GDP, but falling interest rates. And so the interest expense was relatively flat during that time. And that offset is over now. So we no longer have falling interest rates to offset our ever-growing debt levels. And so I think these deficits are set to continue into the 2030s with all sorts of ramifications for nominal GDP, inflation levels, things like that. Well, the dollar reserve currency and the trade deficit are two sides of the same coin as far as the system's currently structured. And so if we back up a second, many countries have temporary trade deficits. The U.S. has had like 50 years of continuous trade deficits, so cumulative trade deficits. And I've been highlighting that's an issue for a while. Basically, it results in deindustrialization. So we're basically, indirectly shipping away parts of our manufacturing base to the rest of the world, running trade deficits with them. And then they're recycling it back into our financial assets. So they're buying our treasuries. Nowadays, they more likely buy Mag 7 stocks. But they're basically, we're kind of selling parts of Michigan and other parts of the Rust Belt, and then we're putting it back into New York through the foreign sector. And the reason that they're linked together, the reserve currency status and the trade deficit, is that the whole world, in addition to the normal uses of currency, the dollar has this extra demand component to it that the whole world uses. So they use it for global cross-border contract denomination, which is not true for most other currencies. They use it for global cross-border financing. So if an entity in Europe lends to an entity in South America, it's often in dollars. Same thing if an entity in Japan lends to an entity in South America or Asia or somewhere, it's often in dollars. And so all of that represents inflexible demand for dollars. And there's over 13 trillion in dollar-denominated debt outside of the U.S. To non-banks, over 18 trillion if you include banks. And that's mostly not even owed to the U.S. That's like owed to other international entities. So it's this big tangled web of structural demand for the dollar. Then it's held as a reserve asset, mainly in the form of treasuries and other securities. And the way that the whole world gets the dollars that they need to keep using that is the trade deficit. And the way that works is basically all that extra demand overvalues the dollar on a trade basis, which makes our import power really strong. So we can buy a lot of stuff from the rest of the world. When we go on international vacations, it's fairly cheap for us compared to other countries in the world. So we just kind of spend dollars out there. And the downside is that it makes our low margin exports uncompetitive, even compared to other developed countries like Japan or Germany before they had an energy crisis, and other kind of wealthy places. And so one of the issues is if you're trying to tackle the multi-decade trade deficit that the U.S. has, which I think is a good thing to do. I think there's a mandate for it. And I think the imbalances have grown so big that it behooves them to do it. The problem is that does come with serious trade-offs. If you're trying to reduce the trade deficit, the fact that the trade deficit is what sends the dollars into the world to use as a global reserve currency becomes an issue. And so basically, there's a cost to the system as structured. So I think we're in a very headline-driven market. So every interview I give, I have to give a caveat that everything that I say could be reversed in a day or two, depending on announcements. And there are periods of time where you're not in a headline-driven market. It's more kind of liquidity-driven and process-driven, whereas right now it's a headline-driven market. I would say the initial kind of I don't think it was particularly well done, even though I've said before that I think there is a mandate to address the trade deficit. Then the question is it being well executed? I think the aggressive tactic had kind of the goal of bringing countries to the table. And it does around the margins. I mean, Europe is kind of in talks, and you got like Zimbabwe to take away their tariffs and stuff. But in terms of the countries that really are contributing to the trade surplus, they're the ones that haven't budged. And then as the initial period went on, we had U.S. stock markets selling off, and despite that, the safe havens like bonds and the dollar were also selling off. So bond yields were going up while stocks were going down, meaning bond prices were going down. And the Treasury Department under Scott Bessent has a specific mandate to try to lower Treasury yields. That's a self-imposed goal that they have. So that was not really working in their favor. And then the dollar index was falling when it was, according to the plan, supposed to be rising during that period. And then when they jacked up tariffs to higher levels, the problem is that those are fairly unsustainable for us. I mean, if Americans, went out and found that their iPhones were twice as expensive, that's not great for the economy. That's not great for votes in the midterm. And so, basically, then the U.S. had to start rolling back its own tariffs, which is to say that they said, okay, here's, first they said, okay, we're going to do a 90-day suspension on the rest of the world except for some of these like lower tariffs. And we're all going to try to focus on China. So we jacked up tariffs to over 100% on China. But then, kind of one at a time, we're rolling those back. So it's like, okay, we're excluding phone makers and computer makers. Then we're excluding like auto parts and car for car makers. Now we have kind of an issue where the biggest corporations are kind of exempt from the worst of the tariffs, whereas a lot of the long tail of smaller businesses that import from China are still affected. And if you kind of outline, is it a good idea to, give big corporations a pass and hurt smaller companies? Most voters, investors would say that's probably not great. So now there's movements to try to roll back the tariffs on the smaller companies, but that would basically be taking back the tariffs unilaterally that we put there in the first place. In addition, I mean, the Asian Financial Group, ASEAN, they had a meeting, I believe, yesterday with China, South Korea, and Japan as well. They're three non-members that are large economies that are around the region, and they all basically came out in unity in terms of kind of push back on these tariffs. So the U.S. is currently trying to form a kind of a blockade against China, which is to say, China's the biggest adversary here in terms of excess surpluses. It's hard to take them on directly, but if they can get everyone else on board or like a quorum of other countries, then they'd have a stronger negotiating position. But so far, that's not going through. If anything, China's building a bigger quorum to work with. And so I think that we're kind of in a standstill now. And at the current time, the executive of the Los Angeles port is saying that shipments are down 30%. And if you give that 4 to 8 weeks, that starts showing up on shelves. And so I think that we're kind of, as we enter the summer, we're facing some of the potential downsides of these tariffs, and so far, at least, not a lot to show for them. So the initial reaction of the bond market was poor, which is that when we had rather disorderly sell-offs in the stock market, normally you see a flight to safety in bonds and the dollar, but we saw bonds sell off and we saw dollar sell off. And normally you see that in emerging markets. That's a capital outflow. That's basically foreign investors looking at an emerging market and saying, I want to pull my money out. So I'm not switching from stocks to bonds. I'm literally just pulling money out of that economy around the margins. And we saw, a bit of that in the U.S. It's obviously different than an emerging market. It doesn't hit us as hard. It's relatively small numbers compared to the grand scheme of things. But basically, when you have stocks down, bonds down, yields up, dollar down, and gold up, that is like an anti-U.S. exceptionalism trade. Goes against really what was supposed to be happening for them at the time. There are a number of us analysts that were not surprised by it because we've been kind of highlighting this issue for a while. Now, as the dust settled, bond yields drifted back down, and now you have a lot of U.S. financial markets pricing in higher probabilities of recession. So not necessarily imminent recession. There's still a lot of uncertainty. There's noise in the data due to like import front running. There's some signals coming in strong, other ones coming in weak. But overall, multiple market participants are pricing in, for example, lower oil prices because of expected lower global demand, slower global economy. as well as just disinflation in general for a period of time as the economy slows down. So bond yields got a little bit of a bid, but not as much as you'd expect given the turmoil. And so I think that that's another thing that they have issues with, which is, a few months ago, a lot of people were optimistic about Doge's ability to cut the deficits. So far, spending is higher this year than it was this time last year. Um, they're not really able to tackle the really big spending areas. So Medicare, Social Security, military, they're going to boost interest expense and veterans benefits. I mean, that's like 85% of the budget. So the other 15%, they can talk about it a lot. They can go trim this agency and get optical wins here and there. But if you're going to go after $1 trillion deficits, you got to touch those big things. And in the 2024 GOP platform, they specifically promised they won't cut Social Security, Medicare, or raise the retirement age. And of course, the Democrats agree on that. That used to be a Democrat position. Now it's both parties' position. This is not the Paul Ryan era of the Republican Party, which was the 2010s. And so there's really no good way to tackle that. Now, I think the current approach is to hope that tariff revenue comes in and reduces the deficit a little bit, which I suspect it will if they keep some degree of tariffs on. I mean, if you have 4 trillion in imports and you tariff it at 10%, you can get $400 billion. The problem is it's not like perfectly linear. So you could, for example, have a slowdown in the economy and less imports, and therefore you could undershoot your tax revenue estimates. And cause other issues there. So that remains to be seen. But basically, deficits are still big, and I think that there's going to be a rocky road ahead in terms of both the fiscal deficit, the trade deficit, multiple fronts. Very difficult problem to address. I certainly wouldn't want to be the one trying to address it.